Assalamualaikum and hi, we are from Group G from Group 1. So today we will be presenting our group project for the subject of basic accounting with the course code BKANK1013. Now let me introduce the team members of Group 1. Group 1 consists of 7 members which are first, Muhammad Fahmy Arrisyam bin Mansor with metric number 294629. Next is Muhammad Anas bin Aziz with metric number 294634. Next is myself, Wan Muhammad Zainuddin with metric number 295445. Next is Sasikumar A anak lelaki Sukumaran with metric number 306159. Next is Nur Ezirra Ezlin binti Muhammad with metric number 294589. Next is Athirah binti Annuar Sadat with metric number 295109. And lastly is Nasreen Raihanah binti Muhammad Nizam with metric number 295233. Next, we will move to the content of presentation. In this presentation, we will cover all of these 4 points, which are first, the scenario that is faced by B. My Honey Sendirian Berhad. Next, we will look at the introduction of this group project. Then we will discuss about CVP analysis and recommendations. And last but not least is about the conclusion or summary of this group project.
Let's dive into the current scenario of the business. Be My Honey Sendirian Berhad is an agribusiness specializing in pure and fresh honey products branded as Sweet Honey. Okay, in 2024, the company sold 30,000 units, generating 600,000 ringgit in sales. For the sale agents who market the product would receive a 15% commission on each sale. Okay, the statement of profit or loss for 2024 reveals a net income of 84,000 ringgit. The breakdown of sale costs and expenses is detailed in the table, which you can refer to as shown. Okay. For 2025, the company aims to achieve a net income to sale ratio of 30%. This requires evaluating and implementing new strategies to optimize costs and improve profitability. Our task is to analyze the situation and propose actionable solutions.
Next, we will look at the introduction of this group project. So basically, this group project is about CVP analysis. So what is CVP analysis? So CVP analysis is a method to estimate how changes in the following 3 factors that affect a company's profit, which are cost, which includes both variable and fixed, sales volume, and also price. So companies use CVP analysis to help them to reach important benchmarks such as break-even point. And then CVP analysis also provides a powerful tool to management for planning and decision making. And there are 5 important components of CVP analysis, which includes sales price per unit, units sold, variable cost per unit, fixed cost, and operating income. And we will also look at the key assumptions of CVP analysis, which are selling price is constant, costs are linear, and in multi-product companies, the sales mix is constant, while in manufacturing companies, inventories do not change, which means that units produced is equal to units sold. Now we will discuss about question 1. Question 1 requires us to calculate 8 different formulas. So first, we need to calculate sales price per unit. The formula for sales price per unit is equals to total sales divided by units sold, which is equals to 600,000 ringgit divided by 30,000 units, and sales price per unit will be equal to 20 ringgit. Then we calculate total variable cost. The formula for total variable cost is equals to variable of cost of goods sold plus with sales commission, and it will be equal to 300,000 ringgit plus 90,000 ringgit, and total variable cost will be equal to 390,000 ringgit. Next, we need to calculate variable cost per unit. The formula for variable cost per unit is equals to total variable cost divided by units sold, which is equals to 390,000 ringgit divided by 30,000 units, and variable cost per unit will be equal to 13 ringgit. Next is total fixed cost. Total fixed cost is equals to fixed cost of goods sold plus fixed advertising expenses plus rental expenses plus administrative salaries and plus insurance expenses, and this will be equals to 60,000 ringgit plus 15,000 plus 12,000 plus 30,000 plus 9,000, which is total fixed cost will be equals to 126,000 ringgit.
Okay, for contribution margin per unit, the formula is sale price per unit minus variable cost per unit. That means 20 ringgit will be minus 13 ringgit, that is equal to 7 ringgit. Okay, for contribution margin ratio is equal to contribution margin per unit divided by sales price per unit. That means 7 ringgit will divide by 20 ringgit equal to 0.35 or equivalent to 35%. Okay, for break-even point in units equal to total fixed cost divided by contribution margin per units. That means 126,000 ringgit will divide by 7 ringgit equal to 18,000 units. Okay, for break-even points in amounts, that's equal to break-even point in units times sales per unit. That means 18,000 units times 20 ringgit. That's equal to 360,000 ringgit.
So hello everyone, I will be presenting about question 2. So in 2024, Be My Honey sold 30,000 units, generating 600,000 ringgit in sales. So the net income was 84,000 ringgit with fixed costs at 126,000 ringgit and variable costs at 319,000 ringgit. So next, we will be calculate contribution margin per unit and the break-even point for the company. So after calculating, I get the selling price per unit was 20 ringgit with a variable cost at 13 ringgit. So this will give a contribution margin of 7 ringgit per unit. And the break-even point is 18,000 units. Next, net income calculation. With a contribution margin of 210,000 ringgit, the net income for 2024 was 84,000 ringgit after covering all the fixed costs. So, the final part of my question is to calculate the units needed for Be My Honey. For 2025, Be My Honey can reach the target net income by selling 18,000 units, or they can make 316,000 ringgit in sales. So, I would recommend the company to boosting the marketing efforts to increase the brand visibility. Next, they can expand in distribution through new platforms or partnership across the world. So next, running product promotions to encourage higher sales. Next, the company also can introduce customer loyalty programs to improve the retention. So last but not least, Be My Honey can control the cost by optimizing the expenses of the company.
Hi everyone, now I will explain about question 3 where we aim to achieve a 30% operating income target. The formula we use is sales revenue equal to variable cost plus fixed cost plus operating income. Let's first compare the current operation and the new target. On the left side, we have the old operating income. On the right side, we calculate for the 30% operating income target. Sales are represented as S and the variable costs and fixed costs are remain the same. For the contribution margin is unknown and need to be calculated. Operating income is now 30% of sales, or we can write it as 0.3S. Now let's move on to calculate the new contribution margin and the selling price to meet the 30% operating income target. By using formula for contribution margin, which sales minus variable cost and operating income plus fixed cost. Then after we solve it by comparing, we get the sales, which is 737,142 ringgit 86 cents. Automatically, we can know the contribution margin, which is 347,142 ringgit 86 cents. Next, we calculate the selling price per unit by using this formula sales divided by unit sold. We finally get 24 ringgit 57 cents per unit. This new selling price allows the company to achieve the desired 30% operating income target while maintaining the same sales value.
For the question 4, we will be calculate assumption. The first one, we will be calculate variable cost per unit, and then we calculate fixed advertising expense from 50,000 to 15,000 plus 2,000, and you will get 70,000. And then we will find the target net income to sales ratio, and the ratio is 30%. 30% multiplied by 1,800,000, and you will get 540,000 ringgit. And then for COGS and gross profit, we will find the variable COGS. We will get 950,000, fixed COGS 60,000, and then kita akan dapat total 1,50,000. And then gross profit sales minus COGS, kita akan dapat 750,000. And then for the final one, we will be calculate the total operating expense. Total operating expenses tu akan dapat 338,000, and then we will calculate the net income. Net income equal to gross profit minus operating expense, dapat 412,000. And then net income compare with the target net income, beza dia adalah 128,000. So the company should reconsider the proposed plan because the increased sales and product quality improvements despite higher advertising expenses do not meet the target net income ratio of 30%. So additional adjustment to cost or revenue generation strategies are needed in this plan.
Today, I'll be presenting a comparison about current sales commission structure versus a proposed new approach and how this change could impact our company's financial performance. Let's start with the current scenario. Our sales for this period is 600,000 ringgit. The sales commission is set at 15%, which means we need to paying 90,000 ringgit as a commissions. When we add other expenses, including cost of goods sold, advertising, general admin, the total expenses come to 516,000. This leaves us with a net income of 84,000 ringgit, and also the net income to sales ratio is 14%. Now let's look at the proposed scenario. Instead of working with sales agents, we propose hiring our own sales staff. We would pay 500 ringgit a month to each of 6 sales agents, which totals 36,000 ringgit annually. After that, with the 5% of sales commission, our total sales commission will be 30,000. Adding the same cost of goods sold, advertising, admin expenses as before, the total expenses would be 492,000 ringgit. This would increase our net income to 108,000 and improving our net income sales ratio 18%. Here is a quick comparison between the two scenarios. In the current scenario, the net income was 84,000 ringgit and the net income to sales ratio is 14%. In the proposed scenario, net income was increased to 108,000 ringgit and net income sales ratio improved to 18%. Additionally, by shifting to internal sales team, we saved 24,000 ringgit in sales related expenses. In conclusion, the proposed change will result in an increase in net income by 24,000 ringgit. It will also bring us closer to our target net income to sales ratio, which is 30%, from improving it from 14% to 18%. Based on the benefits, I recommend we approve the change to hire our own sales staff with a 5% commission is good.
For the recommendation, first optimize pricing strategy. Adjust price based on demand elasticity to improve profitability. Use time-limited discount offer during peak season. Next, focus on cost management, negotiation better suppliers rates or with switch supplier, enhance product efficiency through training or automation. Next, differentiate with enhanced quality. Invest in quality, improve if it drives substantial sales growth. Next, sales commission adjustment. Adopt a mixed approach which reduce salary and commission. Consider transition to in-house sales staff if cost effective. Next, product diversification into complementary product. Leverage digital marketing and e-commerce to expand reach. Next, reach achievable sale target. Use CVP analysis to set realistic break-even and profit target. Incentive sale milestone with bonus. Final, track financial metric, monitor contribution margin, cost and break-even point, adapt strategy dynamically based on market and feedback. For conclusion, analysis revealed that sale price per unit for the organization lies at 20 ringgit and total variable cost amount to Rm 390,000 amount up to Rm 30 ringgit per unit. The contribution margin per unit worked out to Rm 7 ringgit and together the contribution margin worked out to 210,000 for 35% of sale. The break-even point is 18,000 unit or 360,000 in sale as compared to the current net income of 84,000. That will translate the net income to sale ratio of 14%. To better the performance and the sale to be at 30% net income to sale ratio, the company would have to consider the following strategies: pricing control, cost control, and volume selling. This would enhance the profitability of the business as well as it meeting the organization objective. Okay, that's all from us. Thank you.